In this episode, we will talk about how risk management helps cut down losses. It is an important tool and it can help protect traders' accounts from losing all of their money. The risk occurs when traders suffer losses that are bigger and more frequent than winners. Being savvy at risk management will mitigate, prevent, or minimize the damage. If the risk can be managed, traders can open themselves up to making money in the market. It is an essential skill and often an overlooked prerequisite to be a successful trader. Trading can generate a substantial profit, and these profits can be lost in one or two poorly managed trades. In this episode, we will share our strategy and show how you can develop your own and increase your chance to succeed in the market. How important is to plan your trades? The Art of War is a great book, and there are many things we can learn and apply to our own lives. Every battle is won before it is fought is a great example of what General Sun Tzu teaches, and it can be applied to trading. Here, General Sun Tzu implies that planning and strategy, and not the battle itself, wins wars. This war advice can be applied to our daily trading routine. Planning ahead can be the difference between success and failure for most of the traders. Whatever you trade Forex, stocks, crypto, or any other form of security, it is important to have the right tool for the job. First, make sure your broker is the right one for your trading style and the kind of security you intend to trade. Commission prices, execution speed, analytical tools are some of the examples you might take into consideration when choose the best broker for you. Another key part is to understand where your stop loss and take profit points are. To be a successful trader, you must know the price you are willing to pay, the price you are taking profit, and the price you are cutting down your losses. Without it, a trader cannot measure the resultant returns against the probability of the position hitting their profit goals or losses. Gamblers and unsuccessful traders will most often than not enter a trade without having a clear idea of the points for take profit and stop loss. They will rely on luck and emotions might take over their trades. It is also important to understand how much to risk per trade. We follow a very simple rule. Our maximum risk per trade is 2% of our equity. It means we never enter a trade risking more than 2% of our money. So, for every 10,000 we have in our account, if a trade goes against us, the maximum loss we will incur is 200 per trade. Other trades might use 1 or 3%, for example, and that is also fine. However, we strongly recommend you find a risk tolerance that you are comfortable with. Following others is not necessarily the best strategy here, and you need to be comfortable with the risk you are taking. This strategy can also take into consideration the size of your account. You can adjust the risk percentage based on the dollar amount you feel comfortable to risk. As the size of your account increases, so does the position and the dollar amount you are risking. The best way to keep your losses in check is to keep the rule below 2%. If you go over it, you'll be risking a substantial amount of your trading account and creating more pressure over your trade's success. Why set a stop loss and take profit? As we have mentioned before, a stop loss point is essential to a trader's risk management. This is the price at which a trader will close its position and take a loss on the trade. This often happens when a trade goes against the way the trader expected. It prevents the I will come back mentality and limit the losses before they escalate. Following the same principle, a take profit point is the price at which a trader will close its position and take a profit. It is wise to have a take profit target to mitigate the risk of holding a trade and not take any profit. It is a common mistake to fall into a greed trap and end up with no profit at all. To learn how to control your emotions, check out our previous podcast on trading psychology. It will show on the top right corner and I'll add the link in the description. There are different methods for setting stop loss and take profit points. Often done using technical analysis or fundamental analysis, it all depends on your strategy and trading plan. We, for example, set our stop loss based on the ATR indicator for our swing trades as well as our intraday trades. An example of how other traders can set a stop loss or take profit points is using moving averages or trend lines as support and resistance levels. Although we are giving you these examples, we do not base our trades on them and we stick to what works for us. They are just examples and they might work for you. For the long term investors, if you are a long term investor listening to this podcast, this section is for you. Here, an old and very well known saying really applies. Never put all your eggs in one basket. Putting all your money in one stock, for example, is a big gamble, and you could be setting yourself up for a big loss. Diversifying your investment across industry or sector can help mitigate and manage your risk. We strongly advise you not to hedge positions as a risk management unless you are very familiar with the process. It can generate extra losses if you do not know what you are doing. It is the same case as using put options to hedge any loss. Unless you understand it very well, do not go in this direction as it will incur more losses than necessary. Key takeaways from this podcast: plan your trades and follow your system. Set stop loss and take profit. Do not risk more than 2% of your capital per trade. Find your own risk tolerance and risk management that works for you. Check our previous podcast on trading psychology to learn more. If you like this content and want to see more, please hit the like button and subscribe to support this channel. If you have a question or would like to know more about a specific topic, leave us a suggestion. Stay tuned and follow us on our social media channels for more information about stocks, Forex, crypto, NFTs, and the Metaverse. Disclaimer: we are not licensed to provide financial advice. This video is for educational purposes only.